Thanks, Mr. Chairman, and let me just start off by a word of thanks to both of our staffs for the very intense work they've been engaged in the last, 48 hours or so. I think we have essentially reached an agreement on a transit title for this infrastructure bill, and our staffs worked very, very hard to get us there, so I want to thank them. I also want to thank all of our witnesses, both panels. A special thanks to Congressman Loudermilk for joining us today to explain and speak to the very significant damage this proposal would inflict on Americans and our economy generally. It's a fundamental principle of economics that markets discover prices. Sellers want to sell their products for as much as they can possibly get. It's competition with other sellers that force them to lower their prices until they get to about the lowest price they can and still stay in business. Now, the exception to that are when there are monopolies or virtual monopolies, which usually only exist when the government creates or facilitates them. Nevertheless, history is littered with examples of government planners and their failed attempts to override markets and set prices. They fail for many reasons, but mainly because they generate huge unintended consequences and inevitably harm the very people they're supposed to be trying to protect. Proponents of a 36% interest rate cap seem to think it would result in borrowers getting cheaper credit. But that's certainly not the case. In fact, those most in need would simply lose access to credit. If a lender can't recoup its costs, the lender won't make the loan. Studies have found that a loan under $2,600 is usually a money loser for the lender at a 36% interest rate. And that's because there are fixed costs that are associated with the loan, regardless of its size. A Bank Policy Institute has estimated that issuing a 3-month $100 loan would cost a typical bank $35 to issue. Now, if you express that as an annual percentage rate, that's about 140%, meaning a 36% rate cap would make it illegal to offer that loan, so the loan won't get made. And many would suffer if they lost access to small loans. A 2020 Federal Reserve study revealed that 35% of adults could not cover an unexpected $400 expense using cash savings or the equivalent. Who would be at most risk of losing access to the credit? It'd be the 30% of U.S. consumers who have a subprime credit score and the more than 1 in 10 Americans who are credit invisible. Moreover, while I'm skeptical about the evidentiary value of unverified complaints, I would point out that personal loans, payday loans, and title loans each account for less than 1% of consumer complaints in the CFPB's database, which certainly suggests that consumers are not vocally dissatisfied with them. Here's another example that highlights the inflexibility and the problem of an annual percentage rate cap. Consider a renter who's $100 short on rent on the first of the month, but won't get paid until the second of the month. Well, in order to avoid a $50 late fee, she might opt to borrow $100 at a cost of $15, paid back any time over the next several months. If it's 3 months, that would be equivalent to that would be calculated as a 60% annual percentage rate. Well, this happens to be a real product that's offered by a real major American bank, and it appears that it would be illegal under the proposed 36% annual percentage rate cap. Therefore, instead of paying $15 to the bank, the renter would be forced to pay $50 to her landlord. Congratulations. The effects would be far more severe using the all-in rate cap that the Military Lending Act, known as the MLA, imposes. Even though it's called an annual percentage rate, an all-in APR like this encompasses far more than just interest expense. It includes fees, finance charges, and the cost of ancillary products like credit insurance. As a result, a supposed 36% rate cap functions like a much lower limit. Now, this is particularly evident for credit cards. Including even a modest annual fee in the all-in APR calculation can cause an ordinary credit card to appear to exceed 36%. And what's more, virtually all other federal and state laws use a standard annual percentage rate calculation, not the all-in calculation. The result is an all-in rate cap of 36% would preempt even those states that have interest caps that are seemingly set at a similar rate, with the sole exception of Illinois. So while some argue that the MLA should apply universally, service members are not actually reflective of the general population in a number of ways. For one, they have a reliable income source, and different factors affect their readiness to deploy on a moment's notice different than most people consider when ordering their finances. And what's more, research on the MLA's effect suggests that the MLA has had an adverse effect on service members. A survey of service members showed that the percentage of service members suffering financial distress more than doubled from 16% before the MLA's passage to 34% 5 years later. And about 51% of all military families have been denied credit specifically because of the MLA. And research by West Point professors found that payday lending had not adversely affected service members. Although proponents claim extending the MLA to all consumers would help veterans groups have disagreed. In 2019, a number of veterans groups opposed legislation to extend the MLA, with several noting that veterans have more difficulty accessing capital than others. Fact is, Congress should not be restricting, but rather expanding access to credit. Regulators have already made it very, very difficult for banks to offer small dollar credit, and relatively few do. Although federally chartered credit unions can offer payday alternative loans, an NCUA-approved small dollar product, fewer than 600 credit unions nationwide offer them. And in the first half of 2020, the all-in APR for these loans, including fees, exceeded 36%. So presumably under this legislation, this entire category of small dollar lending by credit unions would become illegal. At the end of the day, taking choices away from consumers just is not a good idea. Instead, it hurts the very people it's supposed to help. Thanks, Mr. Chairman.